Welcome to The Derivative by RCM Alternatives. Send it. Hey everybody, welcome back to the show. I'm down here in sunny Palm Beach for a couple meetings. I have a great show for you today. I think we have one of our largest managers we've ever had on the show, PGIM. I gave him a little ribbing for the name. It's always confused me, that name. PGIM. Had two of their guys on. They manage hundreds of billions of dollars. Devang, Gambhirwala, and Lorne Johnson of PGIM, here to talk about what they're doing in the option space, how they think about risk, and how they think about generating returns with that big of assets under management. So send it. All right, welcome guys. Thanks so much for coming on. We are here with Devang and Lorne. I'll let you guys pronounce your last names so I don't butcher them.
It's not that hard. I'm Devang Gambhirwala.
Lorne Johnson, great to be here.
Lorne Johnson. I could have got that one. And where are you guys today? Looks like a fancy studio you got set up there.
That's how it is here in Newark.
You're in Newark?
Newark.
Yeah.
Newark. How's that airport situation working out for you?
Last time I went, it was all right, but yeah, had a few bumps in the road last year.
Yeah, that was a mess, but they got it all fixed up.
Seems to be better.
Love it. And where do both of you live? You commute to Newark from the city, from the area?
So Devang and I are pretty close together. I'm in Hoboken County.
Yeah.
Devang's just a little down the street in Jersey City.
Love it. So some Jersey
I see the Statue of Liberty out of my balcony. So it's right adjacent to Manhattan, downtown Manhattan.
Yeah. We got some of Chicago's finest driving by me right here. So New Jersey people, you Jets or Giants fans?
49ers.
49ers. There you go.
I'm a Dolphins fan, which not much to say about them. Yeah.
I mean, a little bit better than the New York teams, but not much. Well, hopefully our Bears meet your 49ers in the championship game. We both got to get an unlikely win to see that happen.
Hopefully get the same outcome we got a couple weeks back when the 49ers played Chicago.
Yeah, that was a fun game, though. So, Devang, let's start with you. Give us your role there, and then we'll dive into your background a little, and then we'll circle back to Lorne.
Sure. So, again, Devang Gambhirwala. I'm Managing Director and Portfolio Manager at PGIM's Quantitative Solutions Group. I'm responsible for portfolio management for our quantitative equity strategies. And, as part of that, I've been overseeing all our long-short strategies since their inception about 20 years ago. I oversee our portfolio portable alpha strategies more recently. But I've been with PGIM for almost 40 years. So I've been here right out of college. So it's been a long tenure. More importantly, relevant to our conversation today, I've been managing options-based defensive equity strategies for over 30 years. So I've seen a few market cycles, shall we say. But seriously, it's been a fun ride. With my long tenure, I've seen outlived 5 potential CEOs. We've went from a mutually owned firm back when I joined to having an IPO in 2000. We're now a listed company. We've been able to deliver good client outcomes over this period. And, we continue to do so. Again, it's what keeps me going is working with the great bunch of people, both colleagues past and present, including Lorne here, and then, our clients who keep us on our toes. So that's been the ride.
What was your role when you first started? Mailroom or something?
It wasn't exactly the mailroom. I actually joined as a summer intern. I was going to say my undergrad is in computer information sciences here at New Jersey Institute of Technology, right here in Newark. So we basically was working in an investment area, supporting the portfolio managers, running screens. And this is before the PC area. So we're working with these IBM mainframes, and we've come full circle. Now we're back on networks, as you can imagine. Yeah, again, learned a lot, and that's what got me join the firm, and been there ever since. I completed my MBA here at Rutgers University, again, a couple of blocks down from us. And
that famous Big Ten school?
Yeah. And I wish they were doing
you predate Rutgers being in the Big Ten.
That's right.
Lorne, he's raised you 40 years. What do you got? Can you call him?
Not quite 40 with PGIM. I've been in the business a little while. I joined our quantitative solutions group in 2018. I'm responsible for portfolio management, portfolio design, and multi-asset research. Prior to joining our quantitative solutions group, I was leading a portfolio management team at State Street Global Advisors on the multi-asset team there. I've also had some stints in the public sector. I was a asset allocation portfolio manager with CalPERS, also a portfolio manager at ABP Investments in the Netherlands, where I was doing quant investing, and also the hedge fund where I started out, Caxton. So a little bit different road than Devang and jumping around, but I've been with PGIM, the Quantitative Solutions Group, for this is my 8th year now. Prior to coming into the industry, I did my undergrad public administration and history at California State University, Chico. So it was a little bit of an indirect path coming into the business. I did a master's in economics at San Jose State, and then finally a PhD at the University of Washington in economics. When I started that program, I was clear what I wanted. I wanted to be a professor, and that was why I went into a PhD program. That's kind of what you got to do if you want to be a professor. As I worked a lot with data, my dissertation was essays in empirical economics. I found I had an aptitude working with financial data, and that put me on the road to doing interviews with different firms in asset management, and I'm very grateful that that's where I've ended up.
Are you grateful they ripped you away from the beautiful West Coast and put you in the metropolis?
I did get back out there for a little while when I was with CalPERS. I was Sacramento, but it just seems that life has taken me here. Spent most of my professional career here on the East Coast, both in Boston and now down here in the Newark area. Love it down here. Actually, I'd been in New York before when I worked at Caxton, lived in Brooklyn, so was excited to have the opportunity to come back here.
So CalPERS might be the only thing nearly as big as PGIM, right?
Well, where I worked, that was kind of on that scale of CalPERS. That it's not as well known here, but that's a Dutch pension fund.
So let's talk about PGIM. Give me the rough history. I got to say, and hopefully this doesn't upset the compliance, but what's with that name? It's always rubbed me a little bit the wrong way, right? When did you switch to PGIM? Was like 6 years ago?
Yeah, something like that. Maybe 10 years ago. Right. It used to be, Prudential Investment Management, but, yeah, now PGIM, just quick overview. We manage a 1.5 trillion in assets. We're the global investment management business of Prudential, a parent. We're building off a legacy of 150 years. We celebrate 150th year as a firm last year. Of stability, strength, and disciplined risk management as part of our insurance legacy. Gone over, I don't know, I've gone through 5 market cycles, but as a firm, we've gone through probably 30 market cycles, over this period. And our PGIM's global client base, includes public and corporate pension plans, foundations, endowments, sovereign wealth funds, multi-employer pension plans. And we also sub-advise, we have sub-advised accounts with many other financial service firms. So yeah.
It runs Prudential's insurance premiums as well? Like Prudential's cash? Or no? It's all outside clients?
No, we manage both the money for our affiliates within the Prudential family, but and third-party assets.
It's going to stretch my... when I was on the trading floor, I can't remember the sign for Pru. It was something like this, but right, Pru had, well, they called them Pru, first of all, but they had was a little facial sign that would be the signal for Pru's buying 500 or whatever. So what's it like, right? 1.5 trillion in assets. The quantitative group is about how much you're managing?
So, our features, what we now are the Quantitative Solutions Group, we manage over 100 billion in institutional client assets, and across both our quantitative equity platform and our multi-asset strategies, and we manage against a whole wide range of benchmarks, domestic and international. So yeah, pretty broad footprint in terms of what we do.
Yeah, but I'm saying, like, do you ever wake up and pinch yourself and be like, $100 billion, right? Do you look in the mirror every now and then and be like, this is a huge responsibility, or it's just like you're just adding a zero, you're adding more shares, you're adding more contracts. it doesn't really bother you in the quant sense, but
Yeah. Look, I mean, we're institutional money managers, so we manage, huge pools of money, but, we're fiduciaries. So we take, our responsibility very seriously.
yeah. But it's interesting to me, right? 150 years, all that money, institutional. I'm sure you've been called boring and right. But here you're doing, not you personally, but the firm, right? Here you're doing quant. You were early to quant. You're doing long short. You're doing defensive equity. You mentioned portable alpha. So how do you
Yeah.
kind of square those two things, Lauren? I'll let you jump in. How do you square like that being that fiduciary, being very risk controlled with moving into kind of more, I won't say esoteric, it's pretty broadly used across the space now, but at a time, right, was a little niche at the time.
Yeah, well, quant can mean a lot of things. I mean, high level quantitative investing is a systematic approach, often using models to transform data either in a cross section or over time and making decisions based on that. And in contrast to a fundamental manager who is looking at information and kind of making a call, it allows you to work with a lot more data in quant space. Its breadth is our friend. In our quantitative equity space, we're looking at 70,000 different stocks, but we're also doing quant on the multi-asset side, just in terms of the spectrum of what could be considered quant. There's a side of the spectrum that could be called sort of quantamental. People look at models, information, and okay, they're informed by some systematic process, but ultimately there's more of a human element. And then there could be pure systematic. It's all model based. I'd say what we're doing is more towards the systematic, but you always need human intervention. I mean, what is a model? So I was just looking at dictionary this morning, right? Well, there's 7 definitions for model. Let's put aside different types of cars or fashion. A model is a simplified representation of a system, which can be very powerful because it can lead you to some inferences and answers very quickly that you couldn't do without that systematic framework. But ultimately, models will miss things. And so it's very important that you have a human at the controls to evaluate the information and to know something may be going on that's outside of the model. And also part of quant is risk management. So there's, hey, what can I do to beat a benchmark? I've got these great factor models. It's also very much about risk management. And frankly, a lot of what we do in the quant space may not even be about alpha. It's about delivering an outcome based on somebody's risk preference. It's a broad spectrum. What's quant, to your point, 35, 40 years ago, there wasn't a lot of quantitative investing. The early movers, including the PGIM Quantitative Solutions Group, took advantage of that. But as more players come into the space, a lot of the anomalies that you could make money on, they go away. So you constantly have to innovate. And now, we're in this age of AI, which is kind of a supercharged version of what quant was before. The amount of information that you can process and do things with has just leaped from those early days where it seemed just amazing that you could take information on thousands of stocks and come up with a combined view. Well, now we're looking at things like natural language processing, where you're processing millions of words coming out in news releases and saying, hey, there's information there that can inform my quantitative process in real time. Just closing the loop on, what does that mean using that information? I talked about looking at it over time. There's also how quickly you want to use that information. So you could trade once a month and perhaps with the right amount of information, that's fine. And that goes all the way to quantitative strategies trading intraday, or vol control strategies that are evaluating the market every few minutes to see if am I positioned where I want to be in terms of an exposure basis. So always could go on and on, different types of quant.
I love it.
And
Two
we're doing a
follow-ups there.
lot of different things.
One follow-up.
Sorry.
Do you view it, each of you personally, do you view it as a solvable, like is it a clockwork machine you can put back together? Or is it forever unsolvable and you're just trying to get as close as possible with the model?
It's probably
So I'm
closer
going
to the
deep
latter.
there.
Yeah. I wish it was as simple as, we've got it figured out here and we can just run the model and, let it go and it's going to deliver us a positive outcome every day. It just doesn't work like that. And as I alluded to earlier, the model is great, but it can't have everything in it. There are the black swans and things that happen. So you need a human at the helm when something that nobody's expecting happens. And that's often a risk control exercise, right? Let's take our risk down until we get a little bit better picture here, things that are outside of our models. So, again, there's a balance. If you think about the quant as a science, there's an art into how you're going to use it in your investment process.
You stole my thought there of like, is it a constant red queen race, right? Of like, you have to be constantly moving. Like, it's not about creating a new model. It's about fixing the old one that stops working, or right. There was some research a couple of years ago of like, once a factor becomes known, it's basically no longer a factor. Right.
Yeah.
So how do you guys protect against that of like, hey, we came up with this nice thing, but do we publish it? Do we tell our clients? Do we not tell them so it remains as viable as possible? Whoever wants to jump on that grenade, go ahead.
I threw that out early that, hey, back in the day, quant investing, I would say it was easy, but the kind of money you could make just having a simple model of 4 or 5 factors was a lot easier than it is today. So indeed, once people know about the anomaly, it can be arbitraged away. So you got to be a step ahead. We're doing something a little different. It may not be that the concept that you're using is so far removed, but maybe your transformation of the data or the speed at which you're incorporating the data, and that's very much a theme today, the way that complex information can be brought together in real time. Some older quant models, maybe you have to wait until the quarterly earnings release for some of that information. Well, now you can analyze thousands of news stories and come up with a signal every day that's giving you some of those fundamental insights.
It seems to me randomly that people will start to go backwards of like, hey, let's go dig up the old models from the 60s and 70s and see if anything's working, or let's slow everything down and maybe that works better.
Yeah. Everybody's abandoned the old stuff because they don't think it works anymore. And maybe now you could start again.
Let's switch gears a little bit, Devang. You're a options pro. Is that fair? I mean, 40 years with one of the largest asset managers in the world. Come on, give yourself a little credit. So there's a lot of buzz in the industry. A lot of people are doing alternative income, which is really option strategies, buffered, covered calls, all this stuff. Tell us a little bit about how you're seeing the whole space kind of has grown up in the use of options and how you guys view it.
Not as commonly used. Big exposure. But, as you can see now with the kind of proliferation essentially of options-based strategies, primarily through ETFs, this, what was available to a few is now broadly available to a much wider investor base, right? And ETFs have truly, democratized all those, active ETFs are having a moment now, right? A lot of the flows are more inactive as opposed to what we saw over many years with passive index ETFs, for example. But now a lot of the money flow is in the active ETFs. And the fastest growing segment of that is options-based strategies. And they're trying to, whether it be for income or whether it's for, limiting your downside. And,
do you have any worries that it's too democratized, right? That people can chase GameStop up and put their whole paychecks in there and do a lot of stuff that maybe they shouldn't be doing without the 40 years of option knowledge?
Right. Like, don't try this at home, right? I mean, look, you can.
But they are.
Yeah, but they are like, there's a whole class of, of investors now who do a lot of things at home, in front of 3 screens, and they have their real-time feed. But you do need to understand kind of the, how it's not all, easy. And, you have to be mindful of a lot of things, options by their very nature. You have to be mindful of the risks. A lot of people get into it and think it's just a one-way lottery ticket, right? Like,
yeah.
And you can leverage it. But yeah, I mean, it comes with the risks. It really helps to understand options, the systems, the scenario analysis, for example, and really understand option payoffs and how they work. It's a great tool to add more flexibility to what you do in your overall portfolio. But, you don't want to bet the farm on, in a stock or an option on a given stock, right?
Yeah. One thing I would add is there's a perception that maybe, if one is not very familiar with how these popular option strategies that Devang alluded to, particularly ETFs, work, thinking that, well, options are very risky, right? And you could certainly take crazy risks. You could write a naked call, which means basically you're going to pay for any amount the market would go up. In theory, the market could go up 1,000%, and you'd be on the line for that. Most of the strategies that have attracted the AUM and the ETF space have been strategies that actually manage risk, that reduce risk relative to, say, a long-only investment in the S&P 500. So the options are allowing you to target these more specific outcomes in a way that was not available, as Devang mentioned, say even 6-7 years ago. That most of this growth in the active ETF space and options-based strategies really just happened in the last several years.
Put your tinfoil hats on of what could go wrong there, right? Could the tail wag the dog? Could options become bigger than their underlying that they're supposedly representing, and things get a little wonky if we keep seeing this growth?
Observing both the option space and the ETF space, what's interesting is there's no fixed supply the way there might be in an individual security. So because it's so straightforward to create a derivative on something, there's not a limited supply, that there's just not enough options out there and the price is going to go up. The mathematics behind options are such that you can price them very, very precisely. And I would not be someone to say that, if too much money goes into something, that there could be some risks that are created there, but it's unique in this flex option space where the options are created and also taken out of circulation if the demand isn't there. Similarly, ETFs are something like that they are ways to invest in something underlying. And if I come in with a tremendous amount of money to buy a particular ETF, an option-based ETF, for example, there will be
a derivative on a derivative.
Exactly. There will be shares created. So I'm not chasing something that's in fixed supply. So there's not going to be a distortion in the market with that. On the flip side of that, if I want to sell out of that position, the shares will be redeemed and come out of the market, and the market will be back in equilibrium in terms of supply and demands. Again, I will be the last person to say there are no risks on anything, but as it comes to options, particularly flex options, and the ETF ecosystem, it's very self-equilibrating and in many ways is less risky than what you would be doing going after a specific commodity in fixed supply or a specific stock in fixed supply.
A lot of it, kind of the products we see out there, a lot of it are on like these broad-based indices, like the S&P 500 index or the NASDAQ. These are, as you know, broad and deep markets and the largest in the world. So that's kind of eases some of the concerns. Now you go after kind of a less traded stock that's very volatile, and then you buy an option or ETF on that. That's a different story, right? That's not where the growth is. The growth is in these, let's say S&P 500 or NASDAQ kind of based products, which is where most of we see all the asset flow, right? And there you can tailor things and, to meet specific outcomes, as Lorne pointed out. But there's significant liquidity in that, right? And kind of especially in the U.S. markets with these popular indices, and not only in in just underlying index investing, but in the option space, in the future space, in the swap space. So there's extreme liquidity there, and we've been trading these, let's say S&P 500 index options, and now, SP 5, the ETF options are equally liquid, if not more sometimes. Yeah, very broad and deep markets. We get very tight quotes if we go out to quote, an option price, whether it be, 1 month tenor or it could be, 5-year tenor. We see a lot of breadth and depth, and a lot of market participants, as I mentioned, from brokerage firms to hedge funds to, retail investors. So again, not an issue at this point. So, the market can easily absorb kind of the products that we've been talking about.
And do you guys model this flow? Like, has that become a new input of like all this new retail or ETF flow into those options? Like either from an execution standpoint and or like in the models themselves of like this is showing us we've got support or resistance, whatever.
Yeah, I mean, whenever we have to go out to trade, an option or a pair trade, we're buying and selling something, or we're quoting something for for a buffer ETF or what have you. We see there's a lot of participants, and that's one sign. So there's enough market interest and market makers who are making markets in these, and in the pricing, you can see it whether you're buying you're buying something for 10 million or you're buying for 100, again, so you see it in both in the liquidity numbers that there's no issue. And in fact, things have improved, I would say, in terms of liquidity and the kinds of things you can get pricing on. There's a lot of market participants and a lot of market interest, and that's not because things became more profitable. In fact, there's a lot more competition in that space. So we like all the growth in the option space.
Yeah,
Do
one
you
of the
think it's-
indicators.
Sorry, go ahead.
I was
Go
just, it'll be quick. One of the things that we see in our research in pricing options is that, and it's an indication of just how liquid the market is, the spreads that are on options that are traded have narrowed to almost nothing, especially if it's something, say, close to at the money with a horizon of, say, a month to a year. There are more and more players coming in to serve this space to play both sides, right? To buy and sell options. So you can go out there, whatever side you want to take, and somebody's on the other side to provide liquidity.
This is a little wonky, but have you seen it affect volatility pricing? Like, is it dampening volatility, all this new volume into the ETFs? Like artificially so, we maybe could argue?
I've heard that argument made that the apparent volatility in the market is suppressed because so many people are going in and participating in these strategies. I don't think the world's changed that much. We saw in April the VIX spike
Yeah.
to 80. Risk didn't go away. There was a lot of uncertainty at that moment. It's calmed down a bit. If something comes into the market that is at odds with people's expectations or their view of the near future that is going to change behavior, we can see vol spike, and that's going to pass through into option markets. Absolutely.
I'd argue what's happening is we're getting fatter heads and fatter right? So it's like we're pushing all this we're getting rid of all the normal volatility with all this option and market making, and we're kind of suppressing the normal down. But what happens, that makes that April move, volatility goes up that much higher when it does happen. But that's my pet theory.
I mean, you could argue that, right? A lot of these option selling may tighten the VIX, and people have argued the VIX is no longer the fear indicator.
Yeah.
Because of kind of the growth in all these covered call writing or put writing, call writing. But as we touched on earlier, I mean, when uncertainty raises head or there's a market moving event, yeah, you will see it in malls. I mean, and the VIX is just 1 month kind of right, an aggregation of kind of the risk, and we look at that indicator as the be all and end all. But even if you don't see it in the VIX, you will see it when you're trading in the market.
And some would say that risk has been overpriced in many ways. And that's really a reflection of 3 years of up equity markets, and that, why would I buy? The cost of protection is still high, but that the reality is that, well, the market is, it just going up. But of course, that I'll predict will not happen forever.
Yeah. Well, you could argue though the relative cost to those people who've made so much money is not that high. So the absolute cost is still high, but the relative cost isn't. Before we finish up on options, can someone give an example of a flex option, like an actual, what it would look like, just for the listeners who don't know exactly what that is? I'll put my hand up as one of them.
Yeah, so options have particular characteristics. So a strike price is what the level of the option is. So it will determine whether you're going to make money or lose money on an option. If I buy a call 5% out of the money and the market goes up 10, I'm good by 5%. So that strike price is a term of the option. The maturity of the option, over what term? Is it 1 month? Is it 1 year? Then the type of option, European or American. European option only is exercised at the end of the life of the option. American option you can exercise early. And then now there are options to cash settle or not. So these are all conditions of an option contract. And on a listed option, there are some limitations that there aren't options at every single maturity that for a week out or a week and a half out or 5 years out won't necessarily be available, or at a particular strike. Now, what the flex option allows you to do, I can go to the market and ask for the terms exactly that I want. And these are very important for things like defined outcome, where there's a specific amount of protection that I'm looking for. I want exactly 20% downside protection. And I want it for 1 year, and I want a European option, and I want a cash settle. And I don't have to go and look at the listed option, see what's the closest thing for me. I just go straight to market with that, and that's how the flex works. And then it goes
So
up.
like if the S&P is at 69.43, 20% of there is some weird number that's not the exact
Right.
6,200 strike or whatever. I need a 62.16
I
or
just
something.
calculate what that is, and that's going to go in my order, exactly that
Got it.
level.
So they should be called custom options, not flexible options. But I get it.
That's essentially what they are. I mean, and I can trade it. I mean, and the additional beauty is I can trade it and, delta just to the close, meaning I can trade it at 3 p.m. and get the close at 4 p.m. and they will adjust the strike accordingly. So yeah, again, there's a lot of innovation has gone into even in building out the flex option platform from the exchanges and the dealers. So it's really great. Yeah, where you had like 1, 2, 3 months, 6 month, standardized strikes and maturities. And then, things launched on the third Friday of the month. Yeah, with Flex, you don't have to rely on all that. And that's why we've seen that explosive growth. So when we can customize it and you can say, I want to start at the beginning of the month and the year, exactly a year later, or however you design a product. So that degree of freedom has been very important. Options, they still behave and all do the same things, whether it's a call or put option.
Yeah.
But this kind of customization has can really open up, a lot more opportunities for folks to design products to
And
match what
who's on the
most
other
people would want to do. Yeah.
Who's on the other side of that? Just the primes?
That's where
Some
I was
banks?
just going to go. The great thing is you actually have virtually no counterparty risk, because after that flex option is created, it's listed on the OCC website, Option Clearing Corporation. Essentially, your counterparty is the OCC, not whoever came and filled your order. So it's in some ways, well, it's certainly less counterparty risk than if you do an over-the-counter transaction with a bank.
I mean, this is why we started starting investing in flex options back when we did in the mid 90s. Full transparency, right? It's listed, it's fungible. It's not like an OTC option where I buy from counterparty A and then I'm locked in with them. Exchanges price them daily. At the end of the day, you can get a quote from multiple brokers. So yeah, it's really been very, very helpful. And I think everybody in this ecosystem understands like why that's beneficial, not just for everybody, but for the end investor. Target a specific date and kind of an outcome makes it a lot more predictable.
So that's really fueled the growth also of the defined outcome, the buffers of how the groups
Absolutely.
can put those together.
Right. And more product is coming out all the time with different terms. So, a simple version of a defined outcome, 10% buffer, right? You're protecting the first 10% of your losses. There's a cost to that. So you're going to have an upside cap. Let's say it's 15% on that 10%. Well, you've got other variants that have come out that offer 100% protection. You have different outcome periods, 3 months, 6 months, 2 years. And by the way, these are very similar to a lot of products in the insurance market, which I won't get into, which are also hedged with options. And so with the flex options, right, I can come up with anything and I don't have to go see, is that available in the market? I can create it.
I know we touched on it, but the counterparty risk is a big thing. I mean, when the OCC has gone through all these market crises in the last, at least I know in the last 40 years, has made good on every contract. So there's no failure. You don't have to worry about, counterparty not being around, 5 years from now or not getting your payoff. Really very important.
Yeah, you're in court for 2 years fighting over it or whatever.
Right. No, I mean, that's a big advantage. That's helped with the whole growth of the options and the flex options. You don't have to do what, again, many investors do in the OTC market back then. And it was, again, very limited institutional clients. You take the paper of a counterparty, none of that. This is all exchange traded, exchange listed, transparent. That's really been helpful too.
Are you still seeing the demand and the want from your clients for what I might call like classic option protection, right? Of like steep tail downside protection, asymmetric. I can spend 1-2% a year and get that huge payout. If what Lorne said might one day happen again.
Right. Look, I mean, you've gone through the GFC, the big market, the S&P was down over 50% over that year and a half period. Yeah, defensive strategies kind of proved their mettle, right? At the time. So thankfully we haven't had a big drawdown like that since, but we've had, things here and there. We had the COVID kind of drawdown. It was a sharp, and that's the other thing. Things move very quickly now. It doesn't take, you know, 18 months, 20 months to get from peak to trough, but now it can happen in a month. We lost 34%, right, in those 35 days in February of 2020. So, yeah, any strategies that you have in place that can protect on the downside or avoid a drawdown, less ground for you to recover. Now we had a sharp recovery, but again, some of these products and strategies we're talking about, they're adaptive, right? So they can protect on the downside, but then they can also participate on the upside. So that's, again, one of these nice kind of features of these products. So a side benefit is like, these products allow you to remain invested in the market. So you're right, coming out at the worst time at the bottom, and then you miss that whole kind of rebound. So that's another benefit that these products offer. So you remain invested, which we know is good for you in the long term as an investor.
Yeah, I would say that for the current environment, if one is concerned about valuations, we've had this big run, but you don't want to walk away from this big rally, but you do want some protection on the downside, so that asymmetric convexity, that means, hey, I'm going to participate more when the market's going up and less when the market's going down. And a long dated call option gives you that profile. And if you were invested in such a strategy, then yeah, you'd captured a good amount of what's gone on the last 3 years on the upside. But if something happens and there's a shock, it's adaptive. It changes its colors. It times the market for you.
How long dated are you seeing most interest in that being?
So we see the best convexity outcomes investing about 5 years out.
But then they have to
are right, like a car. The minute you take it off the lot, they start dropping in value, right? The decaying instruments, as you know. So the reason you go out further in terms of the tenor is to prevent that time decay, which, like if you buy a 5-year option, as Lorne mentioned, first couple of years, the time decay is minimal. So you're still able to get all the benefits of having, let's say, a call option, but without having to worry about time decay eating away at the value of your option.
Yeah, and then you're rolling it before the theta kicks in. Oh, I was going to say, I wanted one of you to say like, oh my God, all of the clients are giving up on their tail risk and this is a huge signal. But no, there's nothing like that of the clients seeming bored or complacent.
If one is following the flows in these defensive strategies, they just keep going up and up and up.
I mean, there's enough kind of uncertainty and risk out there, right? I mean, funds are good, earnings are good, the economy seems, healthy enough, maybe not for everybody, but generally can see, and the markets don't necessarily follow the economy, but they've been doing well. But yeah, we have, stretched valuations for some time, the equity at least in the US equity space. We're seeing data issues, inconsistency, especially with the government shutdown recently. So that adds a level of uncertainty from policy and rate risk, what the Fed going to do or not going to do. And then, of course, now the geopolitical kind of tensions kind of add to the mix. So again, shifts from the administration, what have you, there's a lot of things to, maybe keep you awake at night. So strategies like what we've been talking about can definitely take some of that uncertainty out of for an investor while not necessarily being out of the market, right? So you kind of hedging yourself, if you will.
Wait, there's geopolitical tensions? I didn't know about this. You mentioned something offhand before, but I want to circle back to it of like that sometimes you're not trying to get alpha, which seems like a weird thing for an asset manager to say, but kind of explain that and what's the other side of that? Just matching a benchmark or giving their defined outcome?
And, thinking about the range of products that are out there. So a lot of these defined outcome products I mentioned, they're a fixed outcome period, right? So the guarantee that you're looking for, whatever protection level and the terms of your upside are provided at the beginning of each outcome period. You can scan across the now multiple offerings that are out there and decide Well, given my objective, look, I've got almost everything I need saved. If I can squeak out another 5%, that's great. But I sure don't want to lose any money. So, what product offering out there lines up with that the best? Whether you're buying a boat or you're financing your kid's college or something like that.
Buying a home or down payment, what have you.
Right.
Yeah.
Now, for a longer term investor, maybe that simple defined outcome isn't ideal. Now, the strategies will reinvest. It isn't as if the ETF goes away at the end of the outcome period. It'll just reinvest in a new term. But there's some risk there. What is the outcome going to look like then? Or do I even want to bother having to time that? There are products that are called ladders that just invest in, say, 12 monthly vintages with 1 year outcome periods. That's one way that you can kind of smooth it out. Or maybe you would want something like these asymmetric convexity strategies that are more set and forget. And there's none of that timing involved. You're uncapped, which over longer bull markets is going to matter a lot, that you're going to be able to participate more on the upside. And then you're not resetting the outcome period. So the downside protection in an extended drawdown just continues, because we talk about the deltas, right? It's like your beta. How much are you exposed to the market? Well, in a down market, you're going to participate less and less in the drawdown, and your ultimate drawdown is going to be a lot less than even what's a fixed drawdown, say, in a defined outcome.
Does anyone ever worry we're becoming too smart at all this? Like we're going to take all the fun out of investing? Right? Or everything just converges to the risk-free rate because we've taken out all the risk?
I think it's almost limitless, the number of offerings that you can do in the space. And it's evidenced by new ETFs coming out almost every week in this space. So defined outcome or income offerings. So we didn't talk a whole lot about it, but you'd mentioned covered calls earlier. That's a over $100 billion space in ETFs from basically zero just 6 years ago. And there's a lot of different variants there, but is it a specific level of income you're looking for, or you want a certain defensive profile? Because these covered call strategies are also defensive strategies, and you could take a lot of risk. So there's doing a covered call on the S&P 500, and then there are single stocks that there are ETFs that have covered calls on single stocks. Now, you are taking on a lot more risk there. I would kind of move that off the category of almost everything that we've been talking about here today, which are generally risk reduction strategies.
Yeah. And I could zag on that and say, just do less stock, right? Just instead of owning 100 shares, do 50 shares, and you're equaling your covered call, and you can go put that extra money in some income producing thing. But people love them. I agree with you there.
You can't lie with the flows.
So let's talk a little what you guys see. It's always funny, right? Because if you think the world's going to end, you're not shifting all your models, right? Your quants, it's quantitative. But still, I want to know your opinions of what you see for the rest of this year. We've kind of already talked that it's high valuations, geopolitical, all that good stuff. Whoever wants to go first, jump on the 26 outlook.
Well, we've had
Rochambeau.
3 years. Yeah, 3 good years in a row in terms of the U.S. equity markets, and now we've seen both the EFA and markets, the developed and emerging markets kind of catch up in 25 and kind of outperform the U.S. market. So that's good. So there's a little bit of a broadening out of
which was like the first time that happened in many, many years, right?
Many years, right? So yeah, so again, we've always believed in diversification. So that's finally kind of paying off, as opposed to just like the Magnificent Seven kind of that we've seen a run for the last many years. Yeah, again, with AI, all new technology, what have you, I think kind of coming more and more into fruition with every passing year. So there's opportunities to participate in all the benefits. We still believe we should be have a fair amount of exposure to equities, mindful of all the uncertainty and risk we touched on. On the interest rate front, things are a little more uncertain, right? We've had our cuts from the Fed. Going forward, we'll see how we do on the inflation front, and if any of these other risks kind of pop out and kind of influence the direction of the Fed going forward. So you can be a little more cautious on the fixed income side of things, shorter duration. in terms of kind of limiting risk. But yeah, I mean, I think, in reference to all what we've been talking about, I think those kinds of strategies that kind of limit your risk make sense. Again, for the benefits of not being out of the market or trying to time the market, and you can get these fairly cheaply in terms of generally the fees has become a competitive market in terms of what the ETFs are priced at. I think we can, from my seat, I can just see continued growth in this options-based ETF space.
So our multi-asset team view is similarly constructive. So that would mean maintaining exposure in risk assets, although cognizant that there continues to be policy uncertainty. The market is rich. Maybe thinking beyond the context of a calendar year, right? There are some interesting themes that we're paying attention to. So for one, profligacy and government spending is not just a US thing, it's global. There's a lot less talk to discipline and maintaining budgets and things, and we're seeing kind of an explosion everywhere in fiscal spending. Now, that was one thing when interest rates were really low a few years ago. They are a bit higher, even though the Fed is cutting and they've come down a little bit. And then around the dollar, so the move to raise tariffs and so forth, at least initially, there was a pretty violent reaction with the dollar selling off and concerns that people would dump their dollar assets. That has been allayed a little bit with some of the initial tariffs being rolled back, but we are seeing some interesting things outside of what we'll call it the most traditional assets. So precious metals, setting new records. These are trades that could be interpreted a number of ways to address a geopolitical risk, but I think put silver aside, which is just going up like crazy, but gold as something of the alternative currency, right? And if you think all currencies are going to have problems because of this unsustainable fiscal stance, and that everybody's going to have to debase their currency. Well, there's gold, which has a fixed supply. I would have never bought gold years ago, but actually I don't think it is such a bad thing right now, given the concerns about the fiscal situation globally.
And does that include, I mean, you do see some ETFs that are including gold in spade, right? They're following the market, but right, do you view it as a defensive asset in that way? It's kind of a different, as you said, it's for inflation, for debasement of the currency, but
yeah, I don't see it as a traditional asset class play where, for instance, if you're buying stocks, you're buying future earnings and you want to participate in that. If you're buying a bond, you're buying a contract basically that you're going to get paid a certain coupon. Gold doesn't have any of that, but historically it has played a role of either being explicitly something that backed currency, or now everything's on a fiat currency. It's the alternative currency.
Yeah, it's a safe haven asset that's become, it's kind of like what we used to look at U.S. treasuries, but yeah, it's just kind of a proxy.
And so now you've led me to Bitcoin. Any exposure there at PGIM, or do you still, that's too risky? And do you think of it as a safe haven?
Our multi-asset team is not allocating to crypto.
Full stop, full stop. All right. We won't wade into that quagmire. I think that's it. You think we'll see buffered notes or defined outcomes on gold? Right? There's probably some ETFs already coming out.
Treasuries already in a product that's out there. Absolutely. There are more niches to be addressed in this space. So to the extent people identify risks in a particular broad asset class, and this is a way to hedge that risk, I see no reason why you wouldn't see more product being offered on more exposures. You've seen it within equities on different indices. The most money is in products on the S&P 500, but there's a pretty substantial amount of money on the NASDAQ and a lesser amount in international stocks and things like that. So because of flex options and the depth of the options market, particularly options on ETFs. So you can get exposure to a lot of things in ETFs. You can write options on those ETFs. If it's a gold ETF, potentially you could have a gold defined outcome ETF on the gold ETF.
And then I'll ask you both for your AI takes with my lens of it, right? I got a deck that was trying to get me to invest in an AI fund. It was basically, the pitch was it's going to save $5 trillion of US labor costs. right? And their multiples right now are based on saving $5 trillion in labor costs. So to me, if you take $5 trillion out of the US market, consumer spending, that's a really, really big problem. And if they don't succeed at that, then their valuations are too high. They get cut in half or worse. So where do you stand on AI with that lens? Like, does it hurt future productivity and earnings, or is it overvalued, or none of the above?
So I guess I would go as far as saying it is a transformative technology, and historical parallels, I believe, are there in what we saw with railroads at the end of the 19th century, radio, and more recently what we saw with the tech bubble. Whereas others have, it was more of an internet delivery bubble, because really what it was, where the investment was, is in fiber optics and things like that. And we know in all of those episodes there was fallout. Right, there was a lot of euphoria in the market, and there were losers. So there were places you could have put your money and gotten absolutely wiped out. But there were enduring investments in things that were truly transformative, and there were beneficiaries from that longer run. AI is a little different than maybe the tech bubble, because some of the highest flyers in the tech bubble actually didn't have earnings to support the stock prices moving higher. At least as far as your biggest players, your NVIDIAs, et cetera. I won't get into the VC-funded startups and things like that are on the AI bandwagon, and how any one of those is going to work out. There is a story there. There's actually massive investing going on in data centers. And there's beneficiaries to that. Will we need all that capacity in those data centers? I don't have an answer for that, but I would venture at least that this is going to have impact going forward, and whether it's $5 trillion in saved labor productivity, or maybe better decision making or better healthcare, that diseases can be identified earlier. I mean, there's going to be benefits from all this investment. Who the winners and losers are going to be, that's hard. So I would predict there'll be some fallout there, but I don't think it's a bust as far as we're investing in something that's going to be enduring and important.
Devang, got anything?
I'm just going to say this: we're in the early innings. It's hard to make any from my seat, predictions about the future. It's obviously there's a lot of potential for all aspects of our lives. And whether it's, over investment today, or is it going to pay off, that's hard to say. Again, Lorne touched on important points. So these are not things that, the big firms are in. Most of the firms in the US and overseas, they are engaging in AI in some way, shape, and form, because obviously it speaks to the kind of productivity that can be gained from that. But again, who knows? Winners, losers, what new industries come into play, things like that. We're in early innings, so a lot to come, but it's exciting.
I want one of you to say yes, the human race is doomed. Yeah. But to me, it's like the difference between all those other technology innovations this is replacing the human brain, right? So it feels more of an issue there. And maybe I'm just getting old and cranky, but it feels more of an issue of like, this is different this time, because you're actually trying to replace the worker there, instead of just a new technology replacing a worker because they were in the buggy whip factory, right? This is actually in every industry try and replace the worker.
It is disruptive. No question about that. Can be more so. I'm not so sure about kind of not having, being as impactful on the, and on kind of in terms of how employment and kind of make humans obsolete. I mean, I'm not quite there yet. I think we need,
well, not all of them, just a third of them, which would crush the economy. Yeah.
Again, if history is any guide, we'd always thought that, like all of us will be unemployed, machines and robots will run the world. And we know that hasn't been the case through the last couple of centuries of just the Industrial Revolution to the Information Revolution and on. We think that we're on the precipice of something like that, really kind of earth-shattering. I guess the human mind is unlimited, and the intelligence cannot be replicated, and needs to be involved in whatever technology has kind of come to play at a given time.
Yeah, I think like all these technological innovations that Devang mentioned, there's big displacement, and there's concerns that I'm going to lose my job, and there's not going to be anything else to do. The reality is, we've got pretty full employment here in the U.S. People will be doing different things, I think. There'll be an adjustment. There will be some people that, whatever function they were doing, that job is going to go away. But I do believe there'll be other ways to take advantage of the technology that creates new jobs.
It'll be like Star Trek. There's no hunger, there's no sickness, there's no money. We just ask the computer, it replicates things. All right, guys, any last thoughts? I think we'll leave it there. This has been fun.
No, it's a great conversation. Thank you. We enjoyed it.
Absolutely. It's great to be here.
All right, guys, we'll talk to you soon. We'll look you up next time we're in New York or do the same in Chicago. Thanks again, guys. We'll talk soon.
Thanks.
That's it for the pod. Thanks to Devang and Lorne. Thanks to Jeff Berger for producing. We'll see you next week. We got a good one. I finally get to talk about uranium on my own pod, which I've been trying to talk about for a couple years now. So good one on uranium. Check it out next week. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.